Welcome back. We're in conversation with Fitch Ratings global economist, Mr. Brian Coulton. Mr. Coulton, we were speaking of the crude oil problems. We're speaking about the Indian rupee freefall. What do you think should be the regulator and the government's response to this? I mean, the textbook response of hiking interest rates, would that be enough?
I think what we're seeing on the inflation front in India is that, some of the agricultural support prices are being adjusted back up again. I think we've got some increases in rents going on. So, we've been through an episode where inflation had reached very low levels in India, and it was appropriate for the central. I think those days are probably behind us. The rupee weakening is going to have an impact as well, and the oil price. So, a lot of factors are pushing inflation back up again, and this inflation targeting framework is relatively new. Okay, so they don't want to risk the credibility which has been built up in the last few years. They won't be prepared to take too many risks and too many chances with that. So I think we are. I think it will be appropriate to see the RBI raising rates a couple more times.
The next policy is in October. The couple more to go before the close of the financial year. You think we could see a steep hike, or would a few rate hikes be sufficient to sort of calm down the nerves right now?
We've got, I think, 25 basis points penciled in before the end of this calendar year, and then one or two more rate hikes after that.
But do you think largely that the medium-term target of 4% consumer price inflation plus minus 2%, that should not be a threat at this point of time, given the current, as we said, the risks from the rupee and the MSP hike and the crude oil prices?
I don't think we see a big threat to bursting out of the target range on the positive side, but we're certainly moving back to the middle. Maybe towards the upper end of that band going forward. I don't think the rupee depreciation on its own is going to be enough to really blow it out of the water, but it's enough to make the RBI want to take some further steps.
I also wanted to get a sense of, one of the regulations we spoke about earlier was the goods and services tax and the recent introduction. Now, the government targets close to 1 lakh crores in revenue every year, every month. That is to meet its revenue target for the year. We've been slightly short of that at 98,000 crores, 96,000 crores in the past couple of months. Does that remain a big drag as well, you think, because of the uncertainty surrounding this new law?
Well, obviously, when you change the tax regime, this fundamentally, it becomes very hard to predict government revenue. So, it certainly brings a new degree of uncertainty. But in terms of the broader benefits of shifting to the GST, I think those have got to outweigh any of these short-term transitional concerns. I mean, this is coming from the UK, where we're about to step out of a single market and realising what damage that's going to do to the UK economy, or many of us are. India has actually just established a single market by having a single rate of tax across the different states. That is going to be very, very beneficial for the economy in the long term, I think. So I think that outweighs any of these short-term concerns, to be honest.
All right. These inward-looking policies of the developed world, whether we're talking about US and China, the tariff wars, or we talking about protectionism in countries like the UK as well. What impact would that have on emerging market economies like India?
Well, I think one aspect of it is probably something that pushes up the value of the dollar. Basic economic theory would tell you if the US puts tariff on its imports, that should be dollar positive. That seems to be panning out. Also, it creates concerns and uncertainty, and so you get safe haven flows to the dollar as well. So in that sense, it puts pressure on emerging markets. We think the recent tariffs from the US on China, the extra $200 billion, so far at 10%, we think that's going to 25%. That will lead to lower growth in China. We don't think the Chinese authorities have the willingness to ease policy so aggressively that there's no growth impact. There will be a growth impact in China. And what we've seen in the world economy the last few years is that when China slows, has a much bigger impact than it ever did in the past. China's economy is so massive now, $12 trillion. So that will have a broader impact on the emerging market world. But I'm not sure that India's probably fairly long way down the list in terms of countries that are directly affected by trade protectionism.
Would you say, fears like, if China is not able to export to countries like the United States, it would dump its goods in, other countries, including its an immediate neighbor, that is India? Are those kind of fears completely unjustified at this point of time?
I think it's quite hard to redirect your exports. Like, I mean, companies spend years building up markets, building up a presence in a certain place. A lot of the tariffs are, essentially affecting US companies that have a production base in China selling back into the US market. How easy it would be for them to reallocate elsewhere? I think that fear is maybe a little bit overplayed.
But, with trade tariffs, trade barriers, I mean, what options would countries like China do? What will they have to do at the end of the day?
I don't see any quick fixes here. I mean, I think that the US concerns that we hear run quite deep, in the sense that seems to be a quite widely held view in the US administration now. It goes well beyond Trump, that China hasn't really played properly by the rules for years and years on intellectual property, market access, and now is the time to get tough with China. I don't, maybe President Trump will be happy with a big announcement and a quick win that before the November midterms, but I don't think that's going to satisfy the Peter Navarros and the rest of the US administration. So I think this trade war is going to be quite long and drawn out, and ultimately China will probably have to meet some of these demands from the US on an ongoing basis. But it will be a very painful process getting there.
But you think India, with its current forex reserves, etc., are we in a better position than, say, a few years back during the financial crisis to be able to weather that storm?
If we look back towards the taper tantrum, 2013, I think definitely there's been improvement since then in terms of reserves and the stance on the monetary policy framework, which is much clearer now. There were some uncertainties back then how monetary policy was being operated. So definitely, the current account deficit is smaller. So we definitely see progress relative to that episode. I think what I would say on the other hand, though, is that, remember, in the taper tantrum episode, the Fed didn't want to raise interest rates.
Yeah.
All the Fed was telling the market was, no, we don't want to ease policy anymore. Now, the market sort of misinterpreted that a little bit, but then the Fed was very quick to come back in and say, forward guidance, that we're not going to be raising rates. This time around, the Fed is determined to raise interest rates. We've got another 6 interest rate hikes from the Fed.
Overall, when you look at the global macros, do you get a sense of, revival now in the economy? I think your global growth forecast was cut this time. Could you give us the reasons why you hold that view?
Global growth right now is still very strong. I mean, 3.3% for 2018 it's a peak global economic growth conditions. We've actually got global growth above 3% for 3 consecutive years, 17, 18, and 19. The last time we saw that was 2004, 5, 6. So, right now, this is as good as it gets for global growth. We do see things coming off as we go into 2019, and then particularly into 2020. The reason we still think growth is going to be quite strong globally next year is essentially US fiscal policy. It's going to remain very expansionary right through calendar 19. But as we get into 2020, that's, I think, when we might see some sharper adjustments. So
you do see the capex cycle also recovering globally?
Definitely. We've seen that in the US, we've seen that in the Eurozone and in Japan. But part of what's happened here is, as labour markets have got tighter and tighter, it's becoming harder for firms to respond to incremental demand by hiring more people. There just aren't the bodies around to do that. So they're being forced, in a way, to invest more in capex. But that should have some upsides to it. It should help productivity, ultimately should help real wage growth.
All right, just to for a closing comment on this, given the current macros globally, what we're seeing with the US, China, what we're seeing with the crude oil prices, what we're seeing on the domestic market as well, what would be the appropriate, reforms or reactions you'd like to see from the government and the regulator in India?
I think one of the areas of reform that is still, very important for India in terms of being able to make the most of the demographic dividend is to make the labour market a little bit more flexible. There's a lot of labour market regulations that make it hard for firms in the manufacturing sector, particularly, to grow, and that's really when you look at development models in Asia that have worked very, very well, it's been that shift from agriculture into manufacturing, which has really driven the growth. To allow that to happen in India, I think labour market reform is one of the next key areas.